If you've ever wondered how traders predict exact reversal points before they happen, this is it. Fibonacci isn't magic, it's math, and today I'll show you exactly how to use it. I'm Emperor BTC, and in this video we're going to do a deep dive into one of the most misunderstood but powerful tools in technical analysis, the Fibonacci retracement. From how to draw it, to how to trade it, to how to combine it with other tools, I'm going to show you the exact approach I've used for years in trending and ranging markets. Let's get straight into it. Before we even touch the tool, let's quickly talk about where Fibonacci comes from and why traders care. Fibonacci retracement is based on a sequence discovered by the mathematician Leonardo Fibonacci. It goes like this: 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on and so forth. Each number is the sum of the two before it. So why does it matter in trading? Well, from this sequence we derive key ratios that show up everywhere, in nature, architecture, even human behavior. These include 0.236 or 23.6%, 0.382 or 38.2%, 0.5, 50%. This is not really a Fibonacci level, but we use it when using our tool for another reason we'll explain later. 0.618 or 61.8%. This is the famous golden ratio. Again, we'll go into more detail later. And then finally 0.786, 78.6%. In markets, these levels act like psychological magnets. When price moves strongly in one direction, it doesn't go in a straight line forever. It pulls back, retraces before the next move. And where does that pullback usually land? Often right on one of these Fibonacci ratios. So when we talk about Fibonacci retracement, we're referring to this exact process. A trending market makes a move and then retraces part of that move. We use the Fibonacci tool to map out where those retracements are likely to occur. So let's make this practical. Let's say we're in an uptrending market, so we're making higher highs and higher lows, and then higher highs and then higher lows. So let's say price rallies from $100 to $200. A 61.8% retracement would land near $138.2. So using our Fibonacci tool, that is the golden pocket ratio. And at those levels, they often align with structure, liquidity pools, or volume shelves, making them ideal areas to watch for bounce or continuation trades. Example, this could be a support and resistance flip of this level. So in confluence, it could be a strong buy. So to be clear, Fibonacci isn't magic and it doesn't predict the future. It's just a framework to understand where traders are likely to step in and where risk reward starts to make sense. And before we go any further, I'm sure there's a lot of you who will not know where to find the tool on TradingView. So it's just on this side in Fibonacci. So there's all these Fibonacci tools. I don't think I've ever really looked at half of them even. But Fib retracement is the tool that we will be using. And then the settings is just double click, and then there's an array of settings in here. And for this video and this strategy, I probably won't be using these two levels. So I only really used 61, which is that golden ratio. The 50 we'll explain shortly, and then the 786. So how do you draw Fibonacci retracements correctly? This is where most people mess up. They either draw it backwards, force it into chop, or slap it on every minor swing and hope for the best. Fibonacci only works when it's applied with structure. So let me show you exactly how to draw it properly and how pros like me actually use it. So one of the key reasons why in this tutorial series that I'm doing here on YouTube that we covered market structure first. It's because you need to be able to identify, are we in a trending market or are we in a ranging market? So let's say this swing low is point A and the swing high is point B. So if we were in an uptrend, as we are, we take our Fibonacci tool, anchor it to the low, and then draw it to the high. You can see in this example, it came down, touched the 618 level, and then pushed up. And then just for the inverse example, say we are in a downtrend. Let's say we draw this high to this lower low. So this is point A, this is point B. We then take our tool, anchor it from point A down to point B. You can see we almost tap it, miss it by a couple of ticks. But again, we can just kind of continue to move on. So this is our new low. This is our new high. So this is point A. This is point B. Let's say we just move on down. Anchor to our low. And make sure we're on our high. You can see again, we just miss it. But again, we just keep going. So then this becomes our new high. This becomes our new low. So this is point A. This is point B. And then you can see if we anchor it here, price comes to our 618 golden pocket and then pushes on lower. Now let's talk about the real zones that matter. The 0.5, the 0.618 and the 0.786. These are where most traders, including smart money, make decisions. Starting with the mid-range point, it is the 50% retracement level. So between the low and the high, if price retraces, this is the mid-range point. And then again, anyone who is familiar with range trading, this tends to be a significant level. The 50% isn't technically a Fibonacci number, as I mentioned in the beginning, but it's watched by everyone. If a trend is strong, you'll often see a bounce from the 0.5, but if price slices through without any reaction, that's your first clue momentum is weakening. Then moving on to the golden pocket, the 0.618 level. This is the level, the golden ratio. Market respects the 0.618 more than any other level because traders trust it. A clean bounce from the 0.618 in trend is a high conviction play, but if it breaks and closes below, it's worth taking a step back. You're likely looking at a deeper pullback or full reversal. And finally, the last line of defense, the 0.786. If the 0.786 holds, it's usually a trap for late bears in an uptrend or a trap for late bulls in a downtrend. But if price closes below it, the trend's likely over. It means sellers are back in control. I would use this level as your last support zone for invalidation. I only care about three zones: the 0.5 for reaction, the 0.618 for continuation, and the 0.786 for trend survival. If we lose them all, it's not a retracement, it could be a reversal. So how would I use fib levels to actually trade? So the difficult thing that can happen is people identify that, say we are in an uptrend, and they're mapping out their points A's and their points B's, and they're using their tool correctly. But what they tend to forget is this tool is okay, it's decent in isolation, but it's even more powerful when you use it in confluence. So say in this example, our trader is following the uptrend and he is looking to buy retracements. But what he isn't taking into account is, say, our point of interest, which are, say, in this instance, this key SNR level. He then thinks that the 618 will hold because it's golden. What happens is he gets caught in a landslide. So instead, what our trader could have done, or what I would recommend doing, is using the Fibonacci tool as potentially an entry after a reaction from a key point of interest or a key SNR level. So say in this instance, we're pushing in an uptrend higher, we get into our point of interest and say we see a huge reaction from it. What you can then do in that instance is anchor your point A and your point B and look to enter on a retracement into the continued sell-off after the reaction at your key SNR level. Let's use the recent BTC price action as a case study. So our higher time frame point of interest in this case is the previous all-time high, a significant point of interest. We've been in a strong uptrend and prices got into our point of interest. So considering we're in a strong uptrend, it would be very simple to just blindly say anchor and look for your long entry. But again, this would not account for the fact that we're at a higher time frame point of interest. So using the logic, we can say we get into a higher time frame point of interest and we get a reaction. We'll then anchor at point A to point B, and you can see price gets into the 618, and you can see the bodies of the candles somewhat respect and stay in and around it, and then we continue with our sell-off. And just to do another example, but for a bullish example, on Solana, let's say in this instance, price gets down into our higher time frame point of interest. In this case, it is a key SNR level. We then get that reaction, and then we take our tool, anchor it to point A to point B, and you can see price retraces into our 618 level, and then in this case runs up to our next point of interest. And then mistakes to avoid, so don't do these: drawing fibs on random or choppy swings, using fibs alone without structure or context, as we covered, using fibs for stop losses. I would prefer you use structure instead. And then thinking fib is a prediction tool. It's not, it's just additional confluence. If this helped you understand Fibonacci deeper, please subscribe to the channel and leave a like on the video and a comment below. Until then, keep your charts clean, your risk managed, and trade level to level. I'll see you guys in the next one.